Assalamu alaikum, ladies and gentlemen. This is the third video in the Basel series and second video on Basel II. I repeat, this is the third video on the Basel series and second video on Basel II. We had earlier spoken about Basel II regarding the standardized approach and we discussed the standardized approach for credit risk and internal rating based approach, and now we will cover the remaining portions in this presentation, which includes the market risk, both the standardized measurements as well as the internal model measurements, internal model approach, and the operational risk, Basel indicator approach, and standardized approach, and advanced management approach, plus the two supervisory review as well as the market risk. So here we cover the remaining portions. So in order to start, let's take a overview about the why Basel II got implemented. Basel I had limitations. People were manipulating it. They were doing a regulatory arbitrage. It was just a fixed number, so it was insufficient sensitivity. It had limited risk exposures, only the credit risk, and sort of a one size fits all approach, and that's why the need of Basel II was felt. Then Basel II regulatory framework, it had the required risk sensitivity. Basically it had difference. It stood for the difference in the credit risk. It included operational risk measurements and overall the risk measurement, rewarding banks for using the advanced approaches. It stopped the regulatory arbitrage. It included the market discipline, which involves the disclosure aspects of it, and the innovation adaptation, designing a dynamic framework to adopt for to meet the evolving. Banks could use their own approaches as well. Now, Basel II timelines were discussed last time as well. In 1999, first consultative paper was produced by the Basel Committee for Banking Supervision. Then 2001, the second consultative paper was introduced. 2003, the final version of Basel II framework came. And 2004, the revised Basel was introduced. And 2006, 2008, implementation began across the countries. Basel II, we last time also we said as three pillars: the minimum capital requirements, out of which we covered the credit risk and the two approaches for credit risk, the supervisory review, which we will touch upon in this review, which basically deals with aspects not covered under the Basel One, such as the banking books, the interest rate risk on the banking books, the liquidity risk, the concentration risk, the strategic risk, the reputational risk, basically all the risk not covered by the the pillar one, and the market discipline, which involves the disclosures. We will delve into each of them in detail. Coming back to this slide, which lays the framework for pillar one, under credit risk, we have the standardized approach and the internal rating based approach. In the internal rating based approach, we have the foundation as well as the advanced ARB, advanced IRB, both of which were covered in the last video, which is the second video on Basel II, and the first video on Basel II, and the second video on the series of Basel II lectures. The other market risk and operational risk of all the approaches we will cover in this video. So starting, what is market risk? To measure, you can only measure what is quantified, and what you first of all, to measure it, you got to know what it is. So market risk is the loss on and off balance sheet positions due to movement in the market prices. And as far as the banking books are concerned, it has four aspects. One is the interest rate risk. Banks have investment in bonds due to Fed or any other central bank in which the bank is located changing its basic rate. They are exposed to interest rate risk. Equity risk, equity moves in an opposite direction to the interest rate because the investors don't find enough returns on the banking instrument of bonds, and they resort to the stock market. So equity risk is the stock market volatility. Foreign exchange, currency revaluation, For various reasons of balance of payments, import export, demand supply, the foreign exchange comes under pressure and it leads to market risk, commodity risk, which is we all know because again geopolitical situations, some demand supply factors, fluctuation in oil, gold prices vary. So under Basel II market risk requirements, for under Pillar 1, banks must hold a capital to cover market exposure. The minimum capital requirement is calculated under, okay. For Basel 2, under Basel 2, for Pillar 1, they have two approaches to measure market risk. One is a standardized measurement method and the other is internal model method. Internal model approach. We will reach each of them. Each of them. First of all, the standardized is standardized measurement method. You have for each of them, for example interest rate risk, you have a sum captured by the maturity bucket plus the issuer specific risk. Like for example, which we'll delve into later, interest, if you have a bond, then the bond has an issuer, the issuer specific risk plus a market specific risk based on the maturity of the instrument. Equity risk, in this case you have a certain specific number like 8% of the gross equity exposure is taken to be equity risk under the standardized measurement method. Foreign exchange risk, 8% of the net open position. You could have different position, you net it out and then you take a certain percent. We'll do an example also. Commodity risk, it's a flat 15% of the flat risk or the maturity ladder. This again we will cover and understand with the help of an example. So let's take one by one. First of all, the interest rate in the books of trading. In how do we measure the interest rate risk under standardized measurement method? So you can see this example, but I will just explain to you in words in a narrative style. For example, if a bank has an investment in a corporate bond which has a 3-year maturity, a corporate bond of 10 million dirhams in a of a corporate, then first of all you take the issuer specific risk. Again, these percentages are given by the Basel, which is for a corporate bond, it's 1.6% of the 10 million dirhams, which is 160k dirhams. You will have a issuer specific risk, then a market specific risk, because a 3-year bucket and a 3-year, the Basel gives a standardized rate of 1%. So you take 1% of the 10 million, which is 100,000. So total 100,000 dirhams plus 160k dirhams is 260k dirham is the total capital charge you have in this. Second is the equity risk. Again, equity risk, you can see the slide, but I'll just explain to you in simple words. For example, if a bank were to have total holding of 9 million dirhams, 5 million of which are in Imar and 4 million are in Abu Dhabi National Energy. Under the standardized measurement method, under pillar 1, there is a way you take a specific charge on it, which is 8%. So 8% of the 9 million, which is 720k dirhams, and then you have a add-on concentration risk as well. For example, to simplify matters, like we know that out of 9 million, 5 million is Imar and 4 million is Abu Dhabi National Energy. To simplify matters, we just say that, like for example, both of them have exposure over 10%. But we'll just take one, like for example, Imar, it has exposure of over like 50%. So of the 5 million, you say, okay, fine, 5 million is Imar, and because it has a high concentration, so we'll have an additional charge. How do you calculate the additional charge? You say, okay, fine, our total exposure is 9 million. 10% of the 9 million, point 9 we will sort of take as a haircut, because 10%, okay, we can manage, our equity can manage, bank's equity can manage. So 10% of the 9% of the total equity you keep as a haircut, which is 0.9 million. Total MR exposure is 5 million, of which you minus the 10% of the total exposure, which is 0.9. So you come up with 4.9. Of the 4.9, you have an additional capital charge, which is 4%. Again, this 4% is given by the Basel. Banks can take a higher depending on their own subjective view. 4% of the 4.9 works out to 164k dirhams. So total will be 720, which you got by applying the standardized factor of 8% into the total exposure, 9, which is 720K, plus the specific additional add-on charge of 160. So your total comes to around 884 as the capital charge for equity risk. Then comes the commodity risk. Hereby, if a bank has or is exposed to trading, commodity trading, or commodity exposure, or has some form of a commodity exposure, gold, metal, then as per Basel regulations of the standardized method, you take a 15% net position or maturity ladder approach if the positions are large and varied. For example, if you have a 12 million long exposure in gold and 4 million short exposure in gold, you are having a positive value in gold and a negative value in oil. As per the standardized method, you are allowed to net them, that is 12 minus 4, 8. And of the 8, you take the 15% charge, which is 1.2 million dirham you take as charge. So hence, though it's not intuitive, but under the standardized method, it allows you to net the exposures in different commodities. Then it's a summary table which will tell you the how we have done. It's a summary table for your to put the things in perspective. Now going on to the internal models approach, Basel II, market risk. In the internal model approach, allows the banks to calculate their own market risk capital using the value at risk models. Instead of applying a standardized measurement figure, banks can use the VAR. So there are two questions arises. Okay, first of all, why use the internal model approach and why use VAR specifically? So why use internal model approach? It is because banks could have a very complex books, various investments, and they believe that sometimes they are at a disadvantage if they use specific percentages, and they can have their own internal models. They have the sophistication, they have the resources available, they have the systems available to calculate, because banks can have the advantage because it reflects the actual risk portfolio than their fixed percentage, and it often not always results in lower capital charges, especially with effective hedging and diversification techniques. Let's look at examples. So before we look at the example, let's use why VAR is used. Why VAR is such an important measure. It came earlier also in the advanced measurement method of credit risk. So why VAR? So VAR qualifies loss at a high confidence level. VAR estimates the worst expected loss, not the worst ever loss, which is stressed VAR, which is a different case. It's the worst expected loss over a defined time horizon, that is 10 days at a 99% confidence level. This allows banks and regulators to assess how much capital is needed to absorb the normal market fluctuations. As I said, it's the worst expected loss, not like the black swan events, but high probability losses, and aligns capital with risk exposures. VAR captures the volatility and correlations of positions in trading books. It factors into account the correlations, and it factors into account the diversification, because it factors correlations, it can factor diversification as well. This ensures that the capital requirements in risk is risk sensitive. It's not a flat number, it varies with the sort of exposure you have. So let's delve in further into this. Key components of the internal model approach is, first of all, the VAR. And let's break what is VAR for a layman. Let's say if you are carrying a wallet with 1,000 dirhams in a stormy day, and someone tells you there is a 99% chance if something goes wrong in the next 10 days, the most you will lose from your wallet is 1,000 dirhams. I'll repeat, if you're carrying 10,000 dirhams on a stormy day, the worst ever loss, someone tells you there's a 99% chance if something goes wrong in the next 10 days, the most you lose is 1,000 dirhams. So this statement has the parameters of VAR. Okay, it's a 99% confidence interval. Okay, 99% chance you will lose that much. 10 trading days, that's a tenor. Minimum 1 year, it tells you the historical data that covers. Data frequency daily, because you calculate such daily these things. And the risk factors are the interest rate exposures, equities, commodities, and back testing, stress testing are also included in VAR. So let's delve further into this VAR. Internal modern approach, Basel approach, capital requirements. It is given over here, but I'll just tell you in words. The capital requirements are calculated max of the previous day's VAR or M, which is a factor, multiplicative factor. It is decided as per banks. Basel recommends a minimum of 3 into the average VAR of previous 60 days. Again, I'll repeat. Capital requirement is the maximum of the previous day's VAR or M, which is a multiplicative factor, into the average of the previous 60 days VAR. Where you can see the slide, M is a multiplicative factor, average VAR, all these are there. And in added under Basel 2.5, incremental risk charge are also, banks are also allowed to give them incremental risk charge. Stressed VAR can be added, but that's a aspect of Basel 2. Basically, they've added on some additional factors as well if the banks feel they are necessary and they feel they can. An example would be, for example, the previous day VAR is 10 million and the average of the last 60 days is 8 million and your multiplicative factor is 3. So the previous day's VAR is 10, and as I said, you have to take the maximum of the previous day's VAR or multiplicative factor into the average of the last 60 days, which is 3 into 24, 3 into 8, which is 24. So 10 and 24, bigger is 24, the capital charge kept is 24 million dirhams. Now, IM approach, the summary, why is it sort of it's a robust banks must demonstrate, it requires a regulatory approval. Everybody can't do it. You need a regulator because the banks need to have a robust control framework, independent model validation. They need to have a strong model validation team. Regular back testing and reconciliation should be done. Stress testing process should be done on whom accurate data infrastructure and caption are needed. Advantage and disadvantage include the risk sensitive and reflects diversification. That's advantage. Major advantage because you're not taking a number, you're actually calculating yourself. Can significantly reduce capital needs. You're not using a number. You could make use of hedging, diversification, because correlations are factored into account. Allows real-time monitoring, is calculated daily and all your positions are doing, so hence the systems are available. You can do daily monitoring. Challenges are required regulatory approval. You can't do it on your own. You need to have your central bank's approval taken. High cost to develop and validate and maintain. Yes, because the systems are quite sophisticated and you have to hire the resources, so yes, the cost is there. And model risk, of course, when you use a model VAR, it's prone to any sort of model risk that comes with it. Comparison of IMV versus standardized approach. Oh, now that I've discussed, it's good time to put into perspective. So absolutely you should know by now, okay, risk sensitivity of the IMA approach is high, standardized approach is low, because standardized approach you just use some specific numbers. In IM approach you have the percentage, you can develop your own internal models. Customization, it's tailored to institution, they use their own data. On the other hand, the standardized method is one size fits all. It's same numbers are applied. Regulatory approval, it's mandatory for the internal model to use. Standardized approach not needed. Complexity, you should know, okay, because there's so much process involved. Complexity is very high for standardized approach. In For internal model approach, for standardized approach, it's low. Capital efficiency, because in standardized approach you have specific models, so potentially it's lower. And on the other hand, in IMG world, it's conservative. You take higher of the thing. Now brings us to the next aspect of it, which is operational risk under Basel II, which is again covered under the pillar one. Operational risk has its own measurement approaches. So it's the risk of loss arising from inadequate or failed internal processes, people, systems, or from external events. And this could include fraud, internal, external, system failures, process failures, cyber attacks, legal risk, business disruptions. However, it includes strategic and reputational risks, which are covered under the pillar, pillar two under supervisory risk. So operational risk has three approaches. One is the basic indicator approach, standardized approach, and advanced management approach. And as they are in increasing level of complexity and risk sensitivity. Basic indicator has low complexity and low risk sensitivity. Standardized has medium, advanced has more. So basic indicator approach is it's extremely basic and extremely easy to understand. All it says is that just apply 15% to your average of gross income in the last 3 years. For banks, I will repeat, it's very simple, 15% into the average of the gross income in the 3 years. However, income in the 3 years, so if you have a loss, then you exclude that. And there's a simple example given as well. To 2021, you make 80 million, 2022, you make 70 million, and 23, you have a loss. So you take 80 and 70, average the amount, and apply after 15. The standardized approach adds a slightly more sophistication to it. What it does is that it, like for example, a bank could have various aspects, various verticals for its working. It could have corporate finance, trading and sale, retail banking, commercial banking, payment and settlements, agency, asset management, retail brokerage, and all. It gives a separate beta factor to be applied to each of their incomes. Like for example, retail brokerage is 12%. These given are given by Basel and as per the risk associated with those area. Asset management 12%, agency services 15%, as Basel believes it has a higher risk. Payment and settlements 18%. There's a higher risk of fraud, higher risk of operational risk over there. So it has a higher number. Commercial banking 15%, higher operational risk. Retail banking 12%, S&T 18%, high operational risk and higher associated. Accordingly, an example of it would be you take the earnings of each, apply them with a factor, and then add them. Take the earnings in the each, apply the factor, and then add them. Coming back to the advanced approach, let me tell you, as per Basel, it is being passed on to, like in Basel 3, it is being deprecated. It's no more in use. Basel 3 has come and it has sort of replaced advanced material approach with other approaches. And again, how it works is that it has internal loss data. Banks don't have much of an internal loss data if it's functioning well, and it has keeps up its license, so there's not much internal data. External loss data, again, you can get from the market, from the various websites. You often see here these news of banks getting fined, so these are all the external data. Scenario analysis, because the data is not much there. Internal analysis, you can speculate how the loss can arise. And then business environment, controllable factors, your own factors, and how if there is a loss, how you can manage them. So loss distribution modeling is applied to estimate capital at a 99.9% confidence level. 99.9% confidence level. And again, the key characteristics of the advanced measurement approach are, it is based on, again, value at risk at 99.9% confidence level over a 1 year horizon. In the other case of market risk, it was 99%. So in operational risk, you take a more conservative view, you take a 99.9%. Requires incorporation of actual loss experience and expert judgment. Again, you have to use the actual loss. They are not money examples, and expert judgment tailored to the bank's operational risk profile, not one size fits all. You have to see what your bank has done. Requires extensive regulatory validation. Since it's you're using your own data, regulator needs to be convinced that you have the sufficient data for you to carry on such a model. Four required data elements. First is internal loss data, your own data, historical loss data collected within the bank. External loss data, which is industry-wise loss data, which you can get from various news and other from various data sources that are available. Three is scenario analysis, which the expert-driven estimations of rare but plausible loss events used to supplement the data. Four is business environment and internal control factors, which are forward-looking indicators like quality control, audit rating, staff turnover, that can affect the operation. You can look at your own, what are the audit rating you're getting, how is the staff turnover for that. Now, advanced measurement approach, the modeling techniques are bank use statistical measurement tools. What are those? Aggregate loss distribution frequency into the severity distribution. Okay, I'll give an example. For example, you can have like a shop, and the shop says over the last 3 years, in the first year I had three losses, frequency. In the second year, I have two losses. In the third year, I had one loss. So this is the frequency. Severity, he says, okay, fine. The first year I had three loss. The total loss was, you can say, whatever, 100 dirhams. Second year, I had two losses. The total loss was 200 dirhams. Though there were two losses, but the theft was of a higher value. In the third year, I had one loss, but there was 1,000 dirhams. So it could be you both factor into account how many and how much is the loss. So bank also should factor into account the operational risk events. Okay, fine, whatever they are, three are there, four are there, and what is the actual loss with those associated with them. So both you take into account the frequency and the severity, and then you have a multiplicative factor. Monte Carlo simulation, it is like that. Banks come up with 1,000 different scenarios of various frequencies and their severity, and then you calculate the 99.9% profile or the percentile of what loss, optimal loss is. And governance and validation, to use the AMA, banks must demonstrate strong governance and oversight of operational risk, independent risk monitoring and model validation teams. You need to have a separate operational risk and a separate model validation team, and regular back testing and model update. If you say your model predicts something, when the year has passed, just see is the model actually, that back testing is done and actually is it within some comfortable range or is the way off. Integration of operational risk into the daily risk thing. That's why you often have clean disk policy. Don't lose anything. Don't whatever the important document are, shred them. Always use your own bank ID. So these are daily process which we bank employees are supposed to follow. Now, advanced management approach, the advantages, as you can see, it's risk sensitive and bank specific. Rewards improved controls and operational risk measurements. May, not always, lead to lower capital requirement if the bank is well managed. And the challenges are, I said, it's highly data sensitive, expensive to implement and maintain, and difficult to validate and audit, because these such events are not very frequent, and since they're not very frequent, difficult to validate. And regulatory scrutiny, then the regulator would come and then he would also analyze, and then you are opening your own books to the regulator. And this was a summary chart of all the three approaches. And as I said, the basic indicator approach, standardized approach, and advanced measurement approach are increasingly in complexity and capital quantity. They are at an increasing level. Now, why choose over what? And it's very intuitive. For small banks, you can use a basic indicator approach. For model, and if you have a little bit complex, for if you have a higher so medium size bank and it has some form of complex books, then you can use the standardized method. But for large bank, where you have sufficient data and you have your resources available, you can use the model validation. So this operational risk advanced measurement approach. Now the Basel Committee identified issues with the comparability and consistency under AMHR approach. As a result, Basel III has replaced advanced. This was what I was telling you, advanced measurement approach with the standardized measurement approach. SMA combines elements of basic indicator approach and standardized approach with new adjustments. It has some adjustments. I'll make a separate video for Basel III. And AMA is now deprecated and will be phased out. Phased out because there are not much examples. It's a very subjective element. The risk are not easy to quantify. If an employee were to do a fraud, how much loss will it do? It's all a very subjective matter. That's why. So again, that brings me back to the pillars, and the second pillar is a supervisory approach, and the capital requirements we will delve in further now. First of all, the supervisory review, as I said, you can read the slide, but I'll tell you basic. The crux is okay, it delves into risk not covered by the pillar one, and such risk include the IRB interest rate books arising from the banking books. They are not trading books. Trading books are covered under the interest rate books. The banking books are the long-term assets like loan deposits not held for trading, and therefore IRRBB is excluded from pillar one, market risk, and that's why this is a supervisory review as well. Plus the liquidity risk are also not covered. So I have a slide here of all the risks that are covered under the pillar two, which is the liquidity risk. That's why banks are supposed to calculate the liquidity coverage ratio, not stable funding position, strategic risk, securitization risk, reputational risk. All these concentration risks are not covered under the pillar one. So this slide gives a good perspective of how the pillar two is different from pillar one, and banks are supposed to give all these ratios and to monitor them and to publish them. Now the last pillar three, and what is it is basically the market discipline. Market discipline under pillar three refers to the requirement that the bank publicly disclose key information about their risk profile, capital adequacy, and risk management practices. That's why in the audit report you have all these banks are supposed to tell you about the qualitative, how they got the capital structure, risk weighted asset, how they've calculated, credit expertise, all their books they need. That's why you have these very thick banking financial books, financial report, because if you see in the notes, all these disclosures are given. So I think this covers my Basel 2, the pillar 1, pillar 2, pillar 3. And soon I will come up with a video on Basel 3, which will cover Basel 2.5, some of the adjustments. And you can, these video there, please kindly subscribe and write and give me comments how to improve my channel. Thank you, ladies and gentlemen.